A tricky balancing act for Chairman Powell. He'll now face criticism that the Fed has bowed to pressure from the White House, or Wall Street, or both, sacrificing the central bank's precious independence. He insists the FOMC, the Interest Rate Setting Committee, is strictly responding to the data.
The president has repeatedly called for this rate hike and for the Fed to end the runoff of its balance sheet. What do you say to those that say that the Fed gave in to what the president wanted today?
So I gave my my reasons for our reasons really for doing this, and you know, just to touch on that again, this action is designed to ensure against downside risks to the outlook from weak global growth and trade tensions, offset the negative effect that those factors are already having, and promote a faster return to inflation of 2%. That's what we've been talking about all year long. And we've gradually moved our policy in the direction of more accommodation. I think what you see is an economy that has reacted well to that. So that's what we're doing, and that's why we're doing it. We never take into account political considerations. There's no place in our discussions for that. We also don't conduct monetary policy in order to prove our independence. We conduct monetary policy in order to move as close as possible to our statutory goals, and that's what we're always going to do. We're always going to use our tools that way. And then at the end, we'll live with the results.
It's two topics, Richard, he can't avoid, the market pressure and the president. And he did just respond just before we came on air to a question about that, about the pressure from the president to not only cut rates, but to stop quantitative tightening, which they've also done. He said, we don't conduct monetary policy to prove our independence.
They say that. This is the problem. They say that. Do we believe them? I suppose we do, in the sense of they're not so obvious as to do that, but you never, as I remember Stan Fisher saying to me, you never really know just what little inkling at the back of the mind of an FOMC member was, well, maybe we should just give the president this to shut him up.
Well, yeah. I mean, I was going to say, Stanley Fisher said it recently, didn't he, that this could cost the Fed its independence, cutting, the positive impact on the economy from cutting rates might be wiped out if there's a hit to the Fed's independence. This is an extremely difficult balancing act.
I think the good thing, if you want to call it that, about this situation, this strange situation we find ourselves in right now, Richard, Claire, the Fed is obviously reacting to the market. The market and the president are on the same page. So Powell can basically dance around this question. He can dance around the Trump question by saying, well, if you look what's happening globally, you look at bond yields, he can justify the Fed's next move, not because the president's yelling at him on Twitter, but because the market is yelling at him by selling stocks. President Trump, by the same token, can say, hey, look, I got him to do what I wanted, but it's not necessarily because he's a lone wolf crying for rate cuts. The whole market wants more rate cuts. But so Trump's agreeing with them, so it's not as if he's forcing the Fed's hand. The market is, Trump's just along for the ride. That's my political observation.
Right, but when
it's probably worked.
Right, but when you say the market is forcing the issue, I mean, the Fed looks at interest rate expectations. It looks, for example, at the yield curve. Does it really look at the equity markets?
It definitely does, Richard, and this was addressed in the press conference today. He said, look, don't look at this rate cut as an action on its own. We have been essentially loosening policy throughout this year by adding the word patient into the statement, and that, he said, has contributed to an improvement in financial conditions, he called it. But what essentially he's talking about is the rise in the S&P 500 this year, which I think is up about 20%. He took some credit for that.
Yeah, the Fed doesn't want to be killing the bull market prematurely. But, you know, also, obviously, rates are still much lower and negative in many cases around the world. So even with this rate cut, you could argue that Fed monetary policy is too tight. And to your point, I don't think the Fed is going to get ahead of that. They're behind the curve in that regard, and they're never going to catch up unless you cut rates to zero and then go below that. I mean, but what good does that do? You don't want to be in a contest with the ECB, how low you can go. That doesn't do anyone any good.
We need to put this into context. What is the justification for today's rate cut? William Foster is with me. Good to see you, sir.
To see you.
Thank you. He's Vice President and Lead US Analyst at Moody's. First of all, do you think today's rate cut is justified?
Yes, I think that the Fed is being precautious in terms of trying to ensure that the economic expansion in the U.S. is going to continue to be relatively strong, that it's going to achieve its dual mandate, which focuses on maximum employment and price stability. And, there's an interesting comparison there. And the risk that they're focused on today really have less to do with the domestic concerns like they did in 2007 and more on some of the external factors that they mentioned today in the statement.
But it's interesting, isn't it? Because you don't often get the Fed, which is concerned with a $20 trillion domestic economy, in the light of implications of global developments. Well, that's the trade war, isn't it? He's talking about the trade problems.
That's certainly one aspect of it. Global growth has been slowing more generally. You've been seeing manufacturing sector in particular slowing. Obviously, there are concerns about the Chinese economy has been slowing more generally over the last few years as it shifts to balance the economy. The EU obviously has its own concerns, and obviously there's Brexit. So there's a whole host of factors externally that one can point to. But certainly the trade issues between the U.S. and trade policy coming out of the U.S. have exacerbated these concerns.
How much is today's cut an implicit acknowledgement that they made an error raising rates in December?
And that's the point that everyone likes to point to. I think what's really important is to go back in time and to look at what the data was saying at that time in the second half of the year and compare that to what you saw in the first half of the year. And ultimately, I think the Fed was making the right decisions based on the data that was coming in.
You think they were right to raise in December?
I'm saying based on the data that was available at the time, and we have to put ourselves back in that position and what one could expect for the future. And trade policy is a big uncertainty that was very difficult to forecast. So ultimately, you can't. There's hindsight bias. You can't make a call today based on what you know now. But clearly, they're trying to accommodate for the future, and that's what's most important.
The real problem here is the perception that the Fed, even the scintilla of possibility, is responding to political pressure from the president. Listen to what the chair said today about that.
We never take into account political considerations. There's no place in our discussions for that. We also don't conduct monetary policy in order to prove our independence. We conduct monetary policy in order to move as close as possible to our statutory goals, and that's what we're always going to do. We're always going to use our tools that way, and then at the end, we'll live with the results.
He may believe that to be true, but most people are starting to say they've caved.
Well, I think ultimately, the central bank independence for the Fed is really important, right? For credibility in the markets, for them to be effective in their monetary policy. That's certainly something we believe that it continues to be the case with the Fed. What's different today is that you have a president that is much more vocal and critical. It's a challenge for the Fed, but ultimately, they are focused very much on the data and making their decisions based on what they think is best for the economy and achieving the dual objective.
Do you think that the Fed needs or should or perhaps might exhibit its independence more in the sense of, it is the silent one in the room. So the only time you hear about it is when Jay Powell gets asked one question in a 2-day testimony where, would you go if you're pushing? He says no. I mean, is there anything, would the market like to, or maybe the market's not concerned? You tell me.
Well, I think the central bank independence is very important for the markets. It's very important for the strength of U.S. institutions and ultimately people's belief and faith in the U.S. Treasury market, everything. So I think it's very important.
We saw today, I think the 10-year was down 20 basis or something. The 10, not a huge amount, but it is heading back down towards 2% again. I think it's 2.2 or whatever, 2.02. Is this a one and done rate cut, do you think? Or do you think there'll be maybe 1 or 2 more to come?
Well, that was the big question today. Is everyone was expecting the 25 basis points, but what's going to happen in the future?
Right.
And I think what the Fed made quite clear is they're going to continue to focus on the data.
Yeah, but if they focus on the data, they won't cut again.
Well, that's maybe your view, but we'll see what's going to come in. Our view is really it's going to depend. I think fundamentally the Fed would prefer not to have to cut. Because they want to preserve the economy space they have for if the economy starts to go into recession, they want to have the capacity to respond quickly through their tools.
And what about its other quantitative efforts in terms of the runoff of the balance sheet? You could stop doing that. That would add a certain amount of liquidity back in again. That would tightening, or you could speed up the runoff of the balance sheet to put more money back in. What would you think there?
Well, I think what they tried to do today makes a lot of sense. They've decided to align the policies, both from the interest rate front and from the quantitative easing front, to ensure that they're not at odds. And so, that makes a lot of sense. But those are two tools that the Fed has at its disposal if it needs to respond to, worse economic conditions moving forward.
The Fed now has, what, 2 to 2.25. So you've got quarter points. You've got a few rate cuts if you need it, haven't you?
You do.
You've got a bit of give there if you should require it, but not comfortable. Would you agree?
Well, based on history, this is obviously it's a much lower amount of space that you have relative to the zero lower bound, and that's really the concern for the Fed right now. Is that this is not the normal position that you'd be in at this stage in expansion, and they're trying to work with that.
Good to see you, sir. Thank you very much indeed.